Hello. Thank you for joining me for my October 2024 market update. Today I want to talk about the Fed's recent actions, where the S&P 500 could be going for the rest of the year, and then some thoughts around protecting and growing your wealth. If we haven't met, my name is Liz Whittaberry, and I am the founder of Best Path Advisors in Colleyville, Texas. I'm a chartered financial analyst and a retirement income specialist. And I do retirement income planning, tax planning, and manage investment portfolios for my clients. And today I want to share some thoughts with you. And I want to start with the markets year to date. And so I'm going to share some charts. And if we look at around the globe, all of the major markets, we see that for the most part, they're up. And that's a good thing. There's just a couple of outliers. Here in the US, the NASDAQ has taken the lead again. And it's a little bit ahead of the S&P 500, which is at 20.8% up year to date. Now, looking at the different countries, again, most of them are up year to date, which makes sense based on the chart that we just looked at. We have a couple of notable outliers, and the big one being Mexico, which is still down more than 20% year to date. But if we come back to thinking about the US, what is driving our returns here in the US? It is still year to date, the large cap, momentum, growth stocks. That's because there's been so much growth in that area through the first part of the year that still is what's driving the year to date returns. If we, however, look at the last 3 months, it's a different picture. Over the last 3 months, the outperformance has been in the small cap, the mid cap, the value stocks, everything but the large cap and momentum and growth stocks. And so that is in part due to the actions that the Fed has taken. So let's talk about the Fed and what they've done. The last time we had a rate cut was in March of 2020. That was in response to the pandemic, and it was after an emergency meeting, and they cut rates down to just about zero. It was a 0 to 0.25% range. That led to high inflation. So in March of 2022, they began to increase rates to combat inflation, and that lasted through July of 2023. We had 11 rate hikes from March of 2022 to July of 2023. And then they've held rates since then until this month. On September 18th, they cut rates for the first time in more than 4 years. Now, that's a positive for the market, certainly, because lower rates reduces some of the restriction. It reduces some of the drag on the economy. And so that's a good thing. But it's interesting that they cut rates by 50 basis points. I was expecting 25 basis points, 0.25%. And so were most of the economists and the analysts that I follow. And the reason we were expecting that is that we're not in a recession yet. In fact, we still have good growth. Atlanta Fed GDP now is showing that we're going to have 3.1% growth for this third quarter. That's the rate update as of tonight. I pulled it up before I recorded this. And with good growth, we're not yet in recession, so they don't need to cut rates to combat recession. We also haven't had a big tail risk event like the Lehman Brothers collapse or the pandemic. So they're not needing to cut rates to stimulate the economy because there's been some sort of this big tail risk event that happened. So why did they cut rates by 50 basis points? It's a very good question, and it's something that we want to watch. The Fed says that they're normalizing policy. So they're trying to bring this in for a landing, a soft landing, meaning they don't want to actually create a recession. They want to maybe create just a slowdown and then let the economy get back to growth, back on track to where it should be. Lower inflation, a little bit lower interest rates, good growth. We've yet to see if that's actually going to occur. We need to remember that there is a big lag between the actions the Fed takes and what actually happens in the economy and in the markets. So it's yet to be seen if we actually get a soft landing. If we do, it will be a very unusual event, and they will have pulled off quite a thing there. But let's hope that they do. In the meantime, the market is going up. And I want to share another chart with you that shows you the rolling average returns of the S&P 500 over the last, from 1960 to current. This was put together by DataTrek. They went back and calculated these rolling average returns, and it's very interesting to look at because the market, the S&P 500, has been down very rarely over a 2-year period since 1960, less than 20% of the time. The average 2-year rolling average return is 17.2%. And we see that as that red line there right below the 20%. And that average 2-year return is very strong, 17.2%. Where we're at right now over the last 2 years is more than 52% up. That's a very strong return for a 2-year period. In fact, that puts us more than one standard deviation above the average. That puts us between that 40% and 60% return between the one standard deviation and 2 standard deviations above the average. And so that's unusual. That's very strong growth. The question then becomes, what happens in response to that? I have a lot of people that say the market is at such a high and it's just got to come down. And that is true. It will come down. It will have those ups and downs, but it doesn't fall off just because it's at a high. It's going to fall off because we hit a recession or we have some big tail risk event, something like that. So for now, the market is going up. And what this research showed was that when there were those unusually high periods of return, more than 40% return, then over the next 2-year period, the market tended to average 17%. And so what that tells me is that we have momentum. Momentum is going to continue until something stops the momentum, something puts a brake on the momentum. But for now, we've got momentum. And that is seen in this year-to-date chart for the S&P 500. What we're looking at is the market over the year. The blue bars are days that it was up. The red bars are or periods it was up. The red bars are periods it was down. The blue line is the 50-day moving average, and the red line is the 200-day moving average. So the average market return over the 50 days, most recent 50 days, is better than the average market return over the most recent 200 days. That's why our 50-day moving average is above our 200-day moving average, and the market is currently above both of those. We've got good momentum, and where we're at now, the path of least resistance for the market is to continue going up. We're expecting the Fed will cut rates again in November at the November 5th and 6th FOMC meeting. That's going to be more positive for the markets. And so the market will most likely end the year up and continue to go up from now. What will pause that again would be a recession. Now, even though the market's going to be going up, it doesn't mean it's going to be just smooth selling. We should expect higher volatility because it's October. October is one of the highest volatility months there is. We also have a lot of market participants trying to figure out what the Fed is doing. The Fed has held rates for so long. Market participants have made decisions on what they're going to be invested in. While rates were at that level, the Fed is beginning to cut rates. The question is how quick, how much, what's that going to look like? And how soon do different market participants need to make some adjustments to where they're invested? We have individuals who are invested in the markets. Then we have the institutional investors. We have foundations. We have hedge funds. We have gamblers and players. There's a lot of different market participants that are making decisions with completely different purposes. Some of them very opposite of each other. And so as the Fed is making changes, what would seem very normal as a reaction for us as individuals would be not the normal reaction for a different market participant. So there'll be buys and sells, and those are going to offset each other and create some volatility. We also have a lot going on around the globe. We've got the election coming up in our country. We've got China starting to stimulate its economy. That's going to have some impact on us here in the US. And the Middle East tensions are still ongoing. They're not cooling off. That's going to have some impact on us as well. And so these things are going to create some higher volatility. And then we've got our economic indicators, and we do need to pay attention to them. Unemployment is beginning to increase, and that is always a sign of potential recession. Unemployment goes up when we're going to have a recession. And so we want to pay attention to that. We don't hear of a lot of layoffs right now, but what has happened is that we no longer have over 2 jobs per worker. We have roughly a 1-to-1 ratio. And that means there's fewer jobs available. That's part of what's fueling the higher unemployment. And so we want to pay attention to those indicators that could tell us that recession is near. Hopefully the Fed has moved fast enough to normalize the economy, but it would be a very rare instance that we didn't have some kind of a recession, even if it was a mild recession or a short recession. And so we want to pay attention to that. And with that said, as you think about where to invest, you need to be thinking about, should you make any changes to your portfolio? Should you adjust your short-term, your midterm, your long-term buckets? If we're going to have a recession, should you have a little bit more in the short-term bucket for now? And should you make any adjustments to where your long-term bucket is invested? Maybe to take advantage of some of the potential growth we're going to have in some areas that are going to do well because of the changes that the Fed is making. You want to monitor the risk and volatility, pay attention to the recession indicators, make sure that you're on top of that. And then I want to point out that we've got just 3 months left in the year. So you want to look at your tax planning. Can you do any tax loss harvesting, tax gain harvesting, Roth conversions, any of the things that would improve your lifetime tax picture? Are there any things that you should do before year end? There's 3 months to get those done. And as you're making changes for the tax planning, use that as an opportunity to also make some tweaks in your portfolio that might make sense. Now, I want to remind you, I've talked the last few times about some areas that do well when interest rates are coming down. So I want to remind you of those. Your small cap companies, we saw that on that 3-month chart, tend to do better when rates are coming down. Value stocks, dividend payers also do well. Companies or sectors that have some interest rate exposure, the financials, the utilities, real estate, those do better in periods where rates are coming down. And then your little bit longer duration bonds and high yield bonds would be another area that could do better. So you want to think about that. Look at your portfolio, look at your retirement income plan, do some stress testing, know that you're going to be okay no matter what's going to happen, but stay invested for the long term so that you can outpace inflation and have the money you need down the road. And with that, I want to wish you a very happy October, and I will see you back in November. Thank you again for tuning in.